so much has changed, right, in terms of the themes which are driving the market. I'm talking not just about the local market here, but I'm talking about global themes. A month and a half back, stocks were ripping higher because there was going to be a soft landing. And now there is a reassessment that maybe we will once again see inflation re-accelerating. So we will get a reflation, no soft landing, no landing. And what does that mean? It should mean good things, right? But as they say, too much of a good thing is sometimes not good. It's actually bad. And that's essentially what I'm trying to put out here. Just take a look at a couple of things, right? First is a measure of US economic data surprises, which is an index. How much is data, US high frequency data, surprising on the upside as compared to consensus? That index is at the highest since 2021, which means that data is coming in strong and stronger in the US. As a result of which, you've got the 10-year in the US, which is now approaching the 4.34 odd mark. That's current cycle highs. And that is essentially being driven by bets which are rising that the Fed may actually need to do more. What we call neutral rate. What is the neutral rate, right? If you remember last year at Jackson Hole, all the entire talk was let's get to at least the neutral rate. Now I guess, and Jackson Hole is around the corner once again, the conversation is going to be, where is the neutral rate? One thought, well, neutral was where the market got to, but perhaps not enough. Because yields are up, government bond returns are now negative in 2023. That's quite something. Just last month, for the year, government bonds were up. These are, a broad benchmark of bonds, global bonds. It was up 3%. So bond prices are falling, and you've got yields which are actually obviously rising. Gold is another commodity which is largely seen as, a bit of a safe haven kind of asset. But look at that. It's down 8 out of the last 10 sessions or so. And of course, steam is being let out of stocks globally as well. Because this started, the market which is down the most is the US. I mean, the NASDAQ is down almost 6.5%, 7% year to date. What was leading the market higher was all these AI stocks, and we've spoken about this earlier, quite NVIDIA and stuff like that. This is the part which got kind of deflated a little bit earlier, but this has stopped now. They're not falling anymore. Another whole bunch of cyclicals is what is in the US leading the downside, and along with it, real yields are also rising. Not nominal yields, but real yields themselves are rising, which is hurting tech, and not just any and all tech, but unprofitable tech, long duration tech, which is basically where profits will be made at some point into the future. So a lot going on. Amidst all of this, right, you got another large part of the global economy which is pulling in the opposite direction. And this is making things even more complicated. I'm talking about China. I mean, China is sort of soft or no landing in the US, and it looks like a hard landing in China. Confidence absolutely rocked there, and outflows out of the equity markets, etc., continuing. Look, you only have to look at the currency there to see what's been happening. So this is the broader kind of global setup that we find ourselves in. I just want to wrap up with how various things or asset classes have done this year. I didn't expect to see Bitcoin there, but it's up 60% this year. Stocks, global stocks are up 11.5%. Nifty is up, by the way, some 6.5%. Gold is up 3.6%. Dollar index has come up, but actually YTD it's flat. Oil, you got government bonds, as I said, which are in the negative now, and commodities are down about 8% or so. I want to just wrap up by saying that the two markets which have been the strongest in the world, not just this year, you go back and look at last year or 2021, have been the US and of course India as well. So it's a stronger markets, and stronger markets usually for good fundamental reason also pull back the fastest more often than not. So keep an eye. But I thought useful to kind of lay the chips on the table in terms of what's really the dominating drivers for the market right now.